Right now, across like thousands of college campuses, there's this massive physical transformation happening. And honestly, it's going almost entirely unnoticed by the average person just walking through a university quad.
Yeah, it's completely under the radar.
Exactly. I mean, the plastic magnetic swipe card, which has been the standard for student access for, what, decades? It's effectively dead.
Oh, totally dead. Yeah.
Universities are undergoing these massive multi-million-dollar retrofits to replace those old card readers with contactless mobile credential systems. So a student just, taps their Apple Watch or their iPhone against a reader and their dorm room unlocks.
Right, which sounds like just a software update, but it's not.
No, not at all. And that's the fascinating part. The fascinating part of this transition isn't the software itself. It's the legacy industrial hardware company that is quietly installing every single one of those new locking mechanisms.
And generating a massive recurring revenue stream in the process, I might add.
Spot on. We are talking about Allegion today, a company historically known for, metal locks, deadbolts, door hinges. But they are currently undergoing this massive evolution into a technology-driven security ecosystem.
Because the physical infrastructure required to support that one digital action, just tapping a phone, it's immense. I mean, every single door on a campus that requires a digital credential needs a highly sophisticated electronic locking mechanism.
We're not just talking about a basic deadbolt anymore.
No. We are talking about motorized latches, localized network connections, battery systems, or even like power over Ethernet wiring. Plus, there's a central software license that ties the entire campus together.
It's a huge operation. So welcome to Talk Tickers. For the retail investor managing your own portfolio out there, our mission today is to really cut through the avalanche of corporate speak. We are doing a deep dive into the Q2 2026 earnings call transcript for Allegion.
That's ticker symbol ALLE, right?
Correct, ALLE. And our goal is to extract the critical signals from this transcript. Whether you are currently holding the stock, maybe you're weighing your options amidst all this market volatility, or you're just eyeing it for a potential entry point.
Yeah, we're going to bypass the fluff today.
Exactly. We're delivering a fast, data-forward, highly actionable verdict on the underlying health of this business. Because the narrative Allegion is presenting to Wall Street points to a highly layered industrial operation. And to understand it, we really need to start with the headline numbers.
Right. And those initial data points from the second quarter, they are designed to capture attention.
Oh, for sure. Let me just rattle these off for you. Revenue came in at $1.2 billion. That represents a 12.7% increase year over year.
Which is a huge jump.
Insane jump. And adjusted earnings per share, or EPS, reached $2.40. That's a massive 17.6% jump from the prior year. Plus, their adjusted operating margin expanded to 24.2%, so up 50 basis points.
Yeah, those numbers paint a picture of a company just, firing on all cylinders.
But okay, let's unpack this for a second, because we have to look at the composition of that 12.7% revenue growth. A lock company growing at nearly 13%.
It sounds a little too good to be true.
Right. In the current macroeconomic environment, top-line growth is frequently a mirage. We see companies constantly reporting these double-digit revenue increases, but they're entirely driven by acquisitions or favorable foreign exchange rates.
Yeah, rather than the core business actually selling more products.
Exactly. When a company buys another firm, they just get to staple that new firm's revenue onto their own balance sheet, which heavily pads the reported numbers. And we know Allegion spent, $70 million on acquisitions in the first half of this year?
They did, yeah. So the first critical distinction we really need to make here is the difference between Wall Street jargon, like reported revenue, versus organic revenue.
Right. Yep. Break that down for us.
Sure. So this is the essential filter for analyzing any industrial manufacturer. Reported revenue includes all of those external factors you just mentioned.
The acquisitions and stuff.
Exactly. It includes the revenue from the newly acquired companies, and it includes currency translation effects, like, say, Allegion sells products in Europe, right? And the euro strengthens against the dollar.
Then the consolidated U.S. earnings look higher.
Right, even if the physical number of locks they sold remained totally flat.
Okay, so that's the mirage. What about organic revenue?
So organic revenue strips away all the acquisitions and the currency fluctuations. It isolates the core pre-existing business and asks, okay, is the machinery you owned last year actually generating more sales this year?
Got it. And what was that number for Allegion?
For Allegion in Q2, their organic revenue increased by 6.9%.
Okay, well, a 6.9% organic growth rate is still a very strong number for a mature industrial company.
It really is.
But, let's take the skepticism one step further. Because over the last 3 years, we have seen countless manufacturing companies post like 6 or 7% organic growth while their physical sales volumes were actually shrinking.
Oh, the inflation game.
Exactly. They achieved that revenue growth simply by pushing aggressive price increases onto their customers to combat inflation. So they sell 5% fewer goods, but they charge 12% more for them.
Right. And that is not sustainable growth. That's just a pricing lever that eventually hits a ceiling. You can't just keep raising prices forever.
Precisely. But the transcript provides a clear breakdown of this from their CFO, Michael Wagness, specifically regarding their Americas segment.
Yeah, Wagness addressed that exact dynamic head-on. He provided the breakdown for the Americas segment, which, by the way, is the primary growth engine for Allegion.
Generating, what, $918.6 million in the quarter?
Yeah, $918.6 million, with an 8.9% organic growth rate. But here's the key part. He stated explicitly that this growth was driven by both price realization and volume growth.
Meaning they're actually physically shipping more units out of their factories.
Exactly. And volume growth is the ultimate indicator of demand. If architects and builders are specifying more physical doors, hinges, and electronic locks, it proves those headline numbers are real.
Right. They're supported by tangible underlying market demand, rather than just inflationary pricing games.
Spot on.
So, to understand why Allegion's volume is increasing while many other industrial sectors are contracting right now, we have to look under the hood at the internal geography of the company.
Because it's really a tale of two continents right now.
It totally is. Allegion is operating under this massive geographic divergence. The Americas segment is experiencing a huge technological boom, while the international segment is acting as a severe anchor on the overall business.
Well, let's examine that Americas segment first. That $918.6 million in revenue and the 8.9% organic growth, it's largely driven by structural shifts in institutional verticals.
Not just standard residential construction.
Right, not just people buying locks for their houses. CEO John Stone dedicated a significant portion of his remarks to the higher education market.
And the mechanics of this higher education shift are just incredible to look at from a capital expenditure standpoint.
Oh, it's massive.
Think about it. When a university decides to transition, say, 30,000 students from plastic swipe cards to mobile credentials, they cannot simply update an app.
Nope. You can't just download a patch for a door.
The physical consequence of that digital shift is a massive hardware replacement cycle. Like a standard mechanical lock on a dorm room or a chemistry lab might cost $50 to $100, right?
Yeah.
And it lasts for 30 years with basically no maintenance.
Right. But an electronic lock that integrates with a campus-wide credential management system, that is a highly complex node on a localized network.
Totally different beast.
You're looking at a fundamentally different product category. These electronic locks require advanced mortise cylinders, secure wireless networking capabilities like Bluetooth Low Energy or near-field communication.
Plus integration with the broader security software platform.
Exactly. And the average selling price of these electronic units is significantly higher than mechanical locks, and the margins are just considerably wider.
It's a gold mine. And John Stone highlighted two specific flagship university deployments during the quarter. He noted that these deployments translated into multi-million-dollar opportunities for Allegion.
Just for one campus.
Just one campus.
Yeah.
Because that revenue isn't just coming from the dormitories. It involves retrofitting the libraries, the administrative offices, the athletic facilities, the research labs.
Every single access point on the campus has to be standardized.
Yes. And furthermore, this creates a highly sticky ecosystem. Once a university standardizes its campus on Allegion-specific software and hardware architecture, the switching costs become astronomically high.
Oh, it's complete vendor lock-in.
Completely.
Yeah.
If they build a new student union building in 5 years, they are functionally obligated to purchase Allegion hardware to ensure it interfaces with their existing network.
And, the ecosystem effect actually extends beyond the perimeter of the university itself.
Oh, really? How so?
Yeah, Stone observed this spillover effect into off-campus housing. So, property management companies that build large apartment complexes near universities, they are highly incentivized to integrate their building security with the university's credential system.
Oh, that makes so much sense.
Right. Students want the convenience of using the same Apple Watch tap to enter their private apartment building that they use to enter the lecture hall.
So the developer practically has to use Allegion.
Exactly. This dynamic essentially forces private developers to purchase Allegion hardware, vastly expanding the total addressable market originating from just that single university contract.
That is brilliant. And you can clearly see this shift toward electronics in the data. The transcript notes that electronics revenue in the Americas residential segment grew in the low teens for the quarter.
And it's up high single digits year to date.
Right. Management views this not as some temporary spike, but as a long-term secular growth trend. So this technological upgrade cycle in higher education is the first major driver for the Americas segment.
It's a huge engine for them.
But there's a second major driver, which Stone emphasized heavily, and that is the massive expansion of hyperscale data centers.
Now, this is fascinating. Data centers have obviously become a focal point for institutional investment lately.
Oh, totally. Usually talked about in the context of advanced microchips or power grid capacity.
Right. But the physical security requirements for these facilities are equally critical, and Allegion has positioned itself directly in this supply chain. Stone reported that data centers now account for approximately 5% of their total non-residential revenue.
Wow, 5% already.
Yeah, and that percentage is expanding rapidly.
Well, let's break down the physical reality of a Tier 1 data center for a second. Because these facilities house hundreds of millions of dollars of highly sensitive computing equipment.
They are literal critical infrastructure for the global economy.
Exactly. So the physical security cannot rely on standard commercial doors and padlocks. I mean, the architectural specifications require military-grade, hyper-specialized entryways.
And this is where Allegion's strategic acquisition of Krieger Specialty Products a few years ago really comes into play. It's central to their dominance in this niche.
What does Krieger actually make?
Krieger manufactures custom-engineered doors and security systems designed for extreme environments. Like, these facilities require blast-resistant doors to protect against external threats.
Blast-resistant.
Wow. And they require doors with sophisticated acoustic shielding.
Oh, because of the servers.
Exactly. The ambient noise generated by thousands of server cooling fans is deafening, and it has to be contained. Plus, they require doors with integrated multi-factor biometric access control systems.
It sounds like something out of a sci-fi movie. But the bidding and specification process for these facilities must be intensely competitive.
It is, but Allegion's sales and engineering teams work directly with the hyperscalers, the major cloud computing providers.
Like the Googles and Amazons of the world.
Right. They work with them during the initial design phase of these massive campuses. By assisting in the design of the security architecture, Allegion ensures that its highly specialized, custom SKUs are written directly into the blueprints.
Which is incredible lock-in again. Because once the campus is constructed, that massive installed base of complex hardware generates highly lucrative aftermarket sales and maintenance contracts for decades.
It's a brilliant strategy.
Okay, so the combination of the higher education retrofit cycle and the data center construction boom provides a really robust explanation for that near 9% organic growth in the Americas.
It does, but we do need to make a technical adjustment when analyzing that second quarter volume.
Right, the CFO's caveat.
Exactly. CFO Michael Wagnes provided a really critical piece of context regarding the sheer strength of the Q2 demand. He noted that a portion of the volume was the result of a pre-buy.
A pre-buy. Okay, the mechanics of a pre-buy are entirely driven by supply chain economics and inventory management, right?
Yep. So Allegion announced a price increase that was scheduled to take effect at the end of May.
Which is a pretty standard maneuver to offset broader inflationary pressures on raw materials and labor.
Totally standard. But when a manufacturer announces a future price increase, it drastically alters the purchasing calculus for major distributors and commercial contractors.
Break that down for us.
Sure. If a distributor knows that every Allegion product will be 5% more expensive on June 1st, they will immediately analyze their carrying costs. They calculate the cost of capital required to purchase and warehouse that inventory a month or two earlier than planned versus the 5% savings on the purchase price.
And in almost every scenario, the math dictates that the distributors should pull forward their orders.
Exactly. They purchase the inventory they intended to buy in July or August, and they execute those orders in May.
Okay, so this behavior creates an artificial surge in second quarter revenue. The demand is legitimate, it's just the timing that's distorted.
Right. And Wagnis was highly transparent about this dynamic. He warned analysts that the pre-buy pulled demand forward from the third quarter.
Which is vital for an investor to understand. If Allegion reports softer sequential revenue in a third quarter, it is not necessarily indicative of fundamentally weakening demand.
No, it's simply the mathematical hangover from that May pre-buy.
Right. And transparency regarding pre-buy dynamics is really a hallmark of conservative management. It prevents the market from extrapolating an artificially high growth rate into future models.
Exactly. It tempers the excitement in a responsible way.
Okay, so that covers the operational mechanics of the Americas segment. It is a powerful engine driven by institutional technology upgrades with a known pre-buy variable affecting the near-term quarterly sequencing.
That's the engine. Now for the anchor.
Yeah, now we must analyze the international segment, which presents a completely different set of operational challenges.
Totally different. So the international segment reported total revenue of $232.9 million. On a reported basis, this looks like a 16.2% increase.
Wait, 16%? That sounds great.
It does, but applying our earlier filter, we see that this growth is an illusion created by corporate accounting. Acquisitions added over 14% to the revenue, and favorable currency exchanges padded the rest.
Oh, wow. So what happens when you isolate the organic revenue?
When you look at the organic revenue, the international segment actually contracted by 1.2%.
A contraction.
Yeah.
And CEO John Stone did not obscure the reason for this contraction either. He directly attributed the decline to deteriorating macroeconomic conditions in Europe.
Specifically citing Germany as the primary headwind.
Right. Germany represents Allegion's largest market within Europe, doesn't it?
It does. And the macroeconomic data coming out of Germany over the past year has just been persistently negative. The industrial sector is in a prolonged slump, mostly driven by high energy costs and slowing export demand.
And when a national economy contracts like that, commercial real estate development is one of the first sectors to freeze.
Oh, immediately. New office buildings, manufacturing facilities, commercial centers, they are delayed or canceled entirely.
So if we look at this like a multi-engine jet, you have the Americas engine roaring, and the European engine is just sputtering out.
That's a great analogy.
This mechanism of localized economic drag forces capital reallocation within a multinational corporation. You have this highly profitable Americas division generating significant cash flow, while the European division is operating in a contracting market, dragging down the consolidated margins.
And the management team has to deploy defensive strategies in Europe to protect the bottom line, because growing the top line is macroeconomically impossible right now.
So what are they doing to stop the bleeding?
The transcript details two specific defensive strategies they're executing. The first is a traditional corporate restructuring program focused on aggressive cost reduction.
Right. Stone announced these actions to basically right-size their European footprint in response to the lower volume environment.
Exactly. And Wagnis actually quantified the financial impact. He stated they are targeting $10 million in annual cost savings.
Okay, 10 million. So they're reducing overhead, likely consolidating administrative functions, tightening their operational footprint just to maintain profitability on those lower sales volumes.
And they expect the full run rate of those $10 million in savings to really materialize in the fourth quarter.
Got it. But the second major issue impacting the international segment wasn't even macroeconomic, was it?
No, this one was painful. It was an internal, self-inflicted operational failure that occurred in the first quarter of the year.
And they are still trying to clean it up.
Yeah. The issue revolves around an ERP implementation.
ERP. That stands for Enterprise Resource Planning, for those who might not be deep into manufacturing software.
Right.
And to understand the severity of this, we really need to detail exactly what an ERP system does inside a manufacturing company.
It is the brain of the company.
Literally. It's the central software architecture that connects every single department. It connects the procurement of raw steel to the scheduling on the factory floor to the warehouse inventory scanners, all the way to the accounting department's invoicing software.
It's all integrated. So if a distributor orders 1,000 door closers, the ERP checks the inventory, allocates the products, alerts the shipping department, and generates the invoice automatically.
So when a company attempts to upgrade or replace its ERP system, the operational risks are just massive.
Huge. And in the first quarter, Allegion's ERP rollout in the international segment encountered severe technical issues. The software modules basically failed to communicate properly.
Nightmare.
Complete nightmare. This disruption meant that factory floors could not accurately schedule production, and warehouses couldn't efficiently pick and ship the finished goods. The internal supply chain essentially seized up,
Resulting in missed shipments, lost revenue, and a massive collapse in their Q1 operating margins for that segment.
Exactly. But the data in the Q2 transcript indicates that the crisis has actually been managed.
Yeah, this is the silver lining here. While the international margins are still down 70 basis points year over year, they improved by a massive 440 basis points sequentially from Q1 to Q2.
And that 440 basis point jump, that is the mathematical validation that the software patches are working, right? The factory floors are communicating with the warehouses again, and physical production rates are normalizing.
The stabilization of the ERP system is a critical metric for investors. Management noted that they intend to spend the second half of the year working through the backlog of orders that accumulated during that Q1 disruption.
So while the macroeconomic environment in Germany remains pretty hostile, the resolution of the internal software crisis at least stops the bleeding on the margin front.
Right. So we have a clear view of the operational realities on both continents now. The Americas are driving technological volume, and Europe is undergoing structural cost cutting while recovering from a software glitch.
Yep. Which brings us to the most critical section of the earnings call for a retail investor trying to model the future value of the stock.
Management's guidance. And the tone of the guidance provided by the executive team is notably aggressive.
It really is. Midway through the fiscal year, management chose to raise their full-year expectations.
They increased their adjusted EPS guidance to a range of $8.85 to $9 per share. But more importantly, they raised their total organic revenue guidance to a range of 3.5 to 4.5% growth.
And the significance of that organic revenue raise cannot be overstated. I mean, they are raising the consolidated growth expectation for the entire company, despite formally lowering their forecast for the international segment to a low single-digit decline.
Which means the mathematics of that adjustment dictate that the Americas segment is outperforming their internal models so significantly that it is easily absorbing the European contraction.
Right, and it's still pushing the overall company growth rate higher.
Now, the confidence required to raise guidance in a mixed macroeconomic environment like this relies on really robust leading indicators. And during the Q&A portion of the call, an analyst inquired about those forward-looking volume trends.
Yeah, CEO John Stone provided a response regarding non-residential specification activity, and it was highly unusual in its lack of ambiguity.
Right, because executive communications are typically heavily sterilized. CFOs and CEOs, they're trained to use hedging language, they discuss stabilizing trends or cautiously optimistic outlooks.
They rarely make absolute statements.
Rarely. Yet, when discussing specification activity, Stone stated, and I quote, "It's as strong as I've seen since I joined the company."
End quote. And to understand why that statement is arguably the most valuable piece of data in the entire transcript, we have to look at the mechanics of architectural specification.
Break it down. What is spec activity?
Specification activity is the ultimate leading indicator for a commercial hardware manufacturer. When a new hospital, or a high school, or a corporate headquarters is in the initial design phase, an architectural firm develops a massive, legally binding document known as the construction specifications.
Right, because the architect doesn't simply draw a door on a blueprint and write electronic lock.
Exactly. Commercial buildings are governed by incredibly strict municipal fire codes, ADA compliance regulations, complex security protocols. The architect must specify the exact brand, model, and SKU of the hardware required for every single access point to ensure the building passes inspection and mitigates liability.
And Allegion employs massive teams of architectural consultants whose sole job is to assist architectural firms in designing these security flows.
Yep. They provide building information modeling, or BIM, software plugins. This allows the architect to easily drop Allegion's specific doors and locks directly into their 3D digital models.
And in exchange for this free design assistance, the architect specifies Allegion hardware throughout the construction documents.
Exactly. It's brilliant. Once Allegion is written into the specifications, they have effectively captured the future revenue. when the general contractor bids on the project and eventually begins construction, they are contractually obligated to purchase the specified Allegion hardware.
And the timeline from the moment the specification is written to the moment the physical product is shipped and the revenue is recognized. That's typically 12 to 18 months, isn't it?
Usually, yes. 12 to 18 months.
Therefore, when John Stone states that specification activity is currently the strongest he has ever seen in Q2 of 2026, he is not guessing about future revenue.
Not at all. He is looking at a guaranteed backlog of architectural blueprints that will require massive hardware shipments throughout late 2027 and into 2028.
Wow. This spec pipeline acts as a massive structural safety net for the company's future cash flows, entirely insulated from short-term quarterly noise.
It's locked in, and the strength of that future pipeline informs how management is deploying their current cash.
Yes, the capital allocation strategy. The strategy detailed in the transcript is highly aggressive. During the second quarter, Allegion generated significant free cash flow and immediately deployed it to repurchase $120 million of their own stock on the open market.
Which brings their year-to-date share repurchases to approximately $190 million. Plus, they paid out $47 million in dividends.
And the mechanics of share buybacks provide a compounding benefit to the retail investor, right? When a company uses its cash to buy its own shares on the open market, they retire those shares, reducing the total number of shares outstanding.
Right. So even if the company's net income remains perfectly flat, dividing that same net income by a smaller number of shares automatically increases the earnings per share.
It is a mathematical lever to drive shareholder value, but it also signals management's internal valuation of the company. A management team will only authorize aggressive buybacks if they believe the stock is trading below its intrinsic value.
And Stone confirmed this explicitly on the call. He stated, "At current share price levels, we do see attractive valuation in our shares and expect to remain active in the second half."
A consistent, heavy volume of share buybacks provides a structural floor for the stock price. If broader market volatility causes a sell-off in the industrial sector, Allegion's treasury is actively stepping into the market with millions of dollars to acquire shares at a discount.
Providing localized price stability.
Exactly. Furthermore, they are executing this strategy while maintaining a highly conservative balance sheet. The transcript notes their net debt to adjusted EBITDA ratio is currently at 1.6 times.
Which, in the context of an industrial manufacturer with highly predictable recurring cash flows, a leverage ratio of 1.6x is incredibly safe.
Yeah, they are not funding these buybacks through dangerous levels of debt. They're funding them through operational cash generation.
Real cash.
Real cash. So we have established the strength of the Americas volume, the architectural spec pipeline, and the aggressive capital allocation. However, we need to analyze one specific segment of the call where management's tone seemed to completely contradict the data they just presented.
Yes. The contradiction appeared during the discussion of the residential market.
Right, because earlier in the call, management highlighted that residential revenue in the Americas grew in the high single digits organically. They cited massive consumer demand for residential electronics. Smart deadbolts, keypad entry systems, integrated home security ecosystems.
It was, by all accounts, a blowout quarter for their residential division.
It was. Yet when analysts pressed CFO Michael Wagnes to project that strength into the third and fourth quarters, his response was surprisingly dismissive.
Yeah, Wagnes basically refused to extrapolate that Q2 residential strength forward. He repeatedly used the word prudent to describe their outlook. He was essentially guiding analysts to model much lower residential growth for the remainder of the year.
Despite the massive momentum they just reported.
Right. And this behavior requires an explanation of how Wall Street analysts construct their financial models, specifically regarding the concept of tough comps or year-over-year comparisons.
Because the market does not judge a company's performance in a vacuum. Every quarter is judged entirely by how it compares to the exact same quarter in the previous year.
Exactly. If a company grew revenue by 20% in Q3 of last year, analysts expect them to grow from that new higher baseline in Q3 of this year.
So Wagnes is managing expectations around a very specific historical anomaly. He reminded the analysts that Q3 of the prior year, so Q3 2025, was exceptionally strong for Allegion's residential business because they executed a massive wave of new product launches.
And the mechanics of a new product launch temporarily distort retail inventory channels.
Right, because when Allegion launches a new smart lock, they don't just sell it to a consumer.
No, they sell it to major retailers like Home Depot and Lowe's. And those retailers have to purchase massive quantities of the new lock to physically fill the shelves in thousands of stores across the country.
Which creates a massive spike in wholesale revenue for Allegion, known as channel fill.
Exactly. That channel fill created an artificially high revenue baseline in Q3 2025. Now, Wagnus is staring at Q3 2026. He knows that he does not have a massive new product launch to generate that same artificial spike.
He has to rely on organic, point-of-sale consumer demand to beat the inflated numbers from last year.
Which is the very definition of a tough comp.
Exactly. If Wagnus were to confidently project high single-digit growth for the rest of the year, and then the residential division only posts, say, 2% growth in Q3 because they couldn't mathematically overcome the channel fill from last year, well, the market will punish the stock.
Oh, severely. The algorithms and the analysts will register a missed expectation, and the stock price will contract even if the underlying consumer demand for the locks is perfectly healthy.
So Wagnus is executing a textbook expectation management strategy. By officially lowering the bar and calling it prudent, he is providing his residential division with a target they can easily step over rather than setting a target so high that they trip.
Smart move. And the transcript also provides data to confirm that the Q2 blowout was legitimate consumer demand, not just another inventory distortion.
Right. Wagnus noted that retail inventory channels are currently at normal levels. This means the high single-digit growth in Q2 wasn't just retailers stockpiling locks in distribution centers. It was end consumers physically purchasing the locks and taking them home.
So the underlying demand is verified, but the financial projection is heavily padded for safety. This is a highly favorable setup for investors, honestly, as it increases the probability of an earnings beat in the subsequent quarters.
Okay, we have dissected the operational and financial mechanics embedded in this earnings call. We've examined the acquisition-adjusted revenue, the price versus volume dynamics, the institutional shift toward mobile credentials, the hyper-specialized data center pipeline, the pre-buy distortions,
The German macroeconomic drag, the ERP stabilization, the leading indicators of specification activity, and that strategic padding of residential guidance. We covered it all.
Yeah, this analysis covers the entire spectrum of the corporate machinery, really translating the spreadsheet data into the physical reality of the business operations. But the ultimate mandate of Talk Tickers is to synthesize this analysis into a definitive, actionable verdict for you, the retail investor.
Right.
Based on the totality of the data presented in this Q2 2026 transcript, the financial modeling implications, and the management team's strategic positioning, we need to determine the trajectory of this equity. So, is the signal derived from this earnings report fundamentally bullish or bearish for Allegion?
The synthesis of the data points heavily toward a definitive bullish verdict.
Okay, a bullish verdict. Let's lay out the precise weighing of the variables that supports that conclusion.
Sure. Look, the negative variables are real, but they are isolated and they're quantified. The macroeconomic contraction in Germany is a significant headwind, absolutely, but it is confined to a segment that represents less than 20% of consolidated revenue.
Right. And furthermore, management is actively mitigating the margin degradation in that segment through that targeted $10 million restructuring program we talked about and the successful stabilization of the Q1 ERP failure.
Exactly. The defensive mechanisms in Europe are functioning, which prevents the international segment from acting as a fatal drag on the broader company.
And conversely, the positive variables in the Americas segment are compounding and structural. I mean, the nearly 9% organic growth is backed by tangible volume increases, not just inflationary pricing.
Right. The structural tailwind of universities upgrading to mobile credentials forces entire campuses into highly lucrative, high-margin electronic hardware replacement cycles. And the rapid expansion of the data center pipeline locks Allegion into hyper-specialized security contracts with the world's largest technology companies.
The growth engines in the Americas are vastly more powerful than the localized economic anchors in Europe.
And additionally, the management team's capital allocation strategy amplifies these operational strengths. They are maintaining a highly conservative 1.6x leverage ratio while aggressively repurchasing shares on the open market, which actively increases the earnings per share and provides a structural floor for the stock price.
And finally, the most critical forward-looking variable, architectural specification activity, is operating at historic highs, guaranteeing a massive pipeline of commercial project revenue through 2027 and 2028.
So translating this bullish verdict into actionable advice for you, the retail investor, really depends on your current portfolio positioning.
Let's break that down. For an investor who is currently holding Allegion stock, what does the data dictate?
It dictates that this is a highly secure hold. The core investment thesis is not only intact, but accelerating, insulated by a massive backlog of commercial specifications and a management team completely dedicated to share repurchases.
Okay, and for an investor evaluating the stock for a potential entry point?
The current metrics suggest an accumulate scenario. The underlying institutional demand justifies the valuation, and the executive team is mathematically demonstrating their belief that the shares are undervalued by deploying $120 million in a single quarter to acquire them.
The data provides a clear mandate for capital deployment based on the operational realities detailed in the transcript. So we have delivered the breakdown, the jargon translation, and the actionable verdict. But as we conclude this deep dive, I really want to leave you with one final perspective-shifting concept regarding the long-term valuation of this company.
Well, this is the multiple expansion idea.
Yes. Throughout this analysis, and honestly throughout Wall Street's general coverage, Allegion is categorized as a legacy industrial manufacturer. They are valued based on the multiples applied to companies that forge metal, bend steel, and ship mechanical hardware.
Which is how they started, to be fair.
True. But when you look at the fundamental drivers of their growth today, the integration of mobile credential software across massive university networks, the engineering of biometric security ecosystems for hyperscale AI data centers, and the transition of millions of residential homes into networked smart lock environments, a totally different picture emerges.
They look a lot more like a tech company.
Exactly. At what point does the market stop valuing this company as a cyclical hardware manufacturer and start pricing them as a sticky, recurring revenue technology ecosystem? Because the moment institutional investors fully recognize that paradigm shift, the valuation multiple applied to this stock will not simply creep upward, it will fundamentally re-rate to align with the technology sector.
And that is the kind of structural revaluation that generates massive long-term wealth for the investors who model it out early.
Absolutely. So consider the mechanics of that multiple expansion as you review your portfolio allocations this week.